Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, it is a big week.
Yeah, we've got a lot of earnings, 4 out of the 7 Mag 7 names report this week.
Absolutely. And that sets the scene for the biggest stories in the $15 trillion global ETF industry. As I mentioned, big week for markets with investors breaking for key economic data and a slew of tech earnings.
Plus, we speak to Travis Spence of JPMorgan Asset Management on why he is convinced 2025 is the year of active investing.
And PGIM's Matt Collins discusses why CLO ETFs remain attractive despite the current market conditions. Eric Balchunas is off this week, so we're switching things up. It's time for today's drill down, where we focus on one ETF. In the hot seat this week, I'm excited about this one. We have the PGIM AAA CLO ETF. We talk about JAAA, the Janus Henderson product, on this show fairly often. This is one of the biggest ETFs focused on this asset class outside of JAAA. It has about $3 billion in total assets, and it's actively managed as you would expect, charging about we actually don't have the basis points up there, but you know, it's pretty low price as well. Let's take a look at the holdings as well, and it's what you would expect. You have Atlas, Battalion, Silver Rock, Oak Hill. These are all CLOs. So let's take a look at the performance as well. The whole pitch around CLOs for the last couple years is that these are floating rate securities, and as such, they should do better when rates are high, and that's exactly what you have seen. We've pulled this chart out to July 2023, which is when PAAA was launched, and you can see that PAAA, JAAA, they're both higher by nearly 13% on a total return basis. You compare that to the AG, which also has done well to its credit, but only higher by about 6.7% on a total return basis. So Scarlett, one of the big questions hanging over these very popular products is, what happens when rates come down?
What happens when rates come down? All right, let's bring that question to Matt Collins. He joins us now. He is head of ETFs over at PGIM Investments. It's great to see you, Matt, and thank you for joining us. We know that the Trump administration wants to get rates down. Whether they succeed, we'll see, certainly. But how do you see this playing out in terms of demand for these kinds of products when rates do eventually come down?
Well, first of all, the path of interest rates, I think, take far longer than most people expect to switch, right? We predict, and it feels like 6 months to a year, then it happens. However, as we look at floating rate securities, whether it's ultra short world or PAAA, the hunt for yield doesn't stop whether rates are at 0 or 5%. Everyone is looking for basis points above risk-free. So we don't really view this as a rate play. We view this as your slow and steady allocation in a portfolio regardless of the rate environment.
So what's interesting about these CLO ETFs, they launched amid much skepticism a couple years ago, and they've held up pretty well. I mean, the flows speak for themselves, as do the performance, but you did see some hiccups starting about a month ago. We had all of that market volatility, and you saw PAAA and some of its peers really gapping out when it comes to its net asset value. You had the share price trading at a discount. Those discounts have since been repaired, but really that was the first real test that a lot of these products have undergone. And there are still concerns out there that you're going to see CLO issuance really drop. The market could freeze. And I'm wondering, you know, what kind of feedback, what kind of concerns are you hearing from your clients and investors?
Sure. So we manage $140 billion of securitized assets. 70 billion of that is CLOs. So we've been in the CLO market since 2008. We've managed liquidity through the financial crisis, COVID, through today. We've seen how these behave. And I'll give you at least what I believe is an interesting stat. If you look at the worst 12-month drawdown of AAA CLOs, it's a negative 1.6%. Compare that to the AG at 16% drawdown. So while you may have very short periods of a drawdown, they tend to be very limited, right? So if you look at daily returns, right, so really narrow the window, 96% of daily returns on AAA CLOs are positive. Compare that to the AG again, 56%. So it is a drastically different profile than the AG. And to get to your question on CLOs, if you lump CLOs as a group, there's a big difference between AAA, AA, and as you get to BBB, drastically different. And when you focus on AAAs, the drama surrounding sort of the questions around CLOs and how they hold up goes away because AAAs are very resilient.
Who are the buyers who are most interested in these products at a time like this?
Well, let's go before ETFs. Before ETFs, this is a $1.3 trillion industry, right? So scratch the ETF label off. It's a huge industry. Before ETFs, it was insurance companies like Prudential Financial and PGIM, and banks and asset managers, but very pockets. Bring in an ETF, everyone's like, it has the most incredible Sharpe ratio relative to any other part of the bond market. So bring that in. As financial advisors and REAs look at that, they're reassessing the building block approach of their portfolio because of these really interesting stats of AAA CLOs that they couldn't access before. So if you look at the waves, it's traditional asset managers, financial advisors, and REAs, and we think the next boom is the individual DIY investor.
Well, I find that really interesting, and a story I'd been thinking about writing before all the volatility happened and everything went out the window was that it feels like power is shifting in the CLO market. You've introduced this entirely new buyer to the asset class through the vehicle of ETFs, and not necessarily saying that's a bad thing, but you have seen ETFs have an impact on the underlying market. We know that, over the past couple of years, it's been sort of traced back to some of the spread tightening that you've seen in the underlying securities. And I just wonder how you think about that. Obviously, PGIM has a lot of experience in securitized assets, CLOs being one of them.
So CLOs, from our perspective, are a timeless investment. And if you think about the sort of the common building blocks out there, the hunt for yield, most investors are constantly seeking income. The question is, does that income get completely overwhelmed by the risk? Right, so whether it's even in the equity market, you've seen a ton of demand to income equity. Maybe that yield is 8%, let's say, but you're subject to drawdowns that overwhelm an entire year's worth of income. AAA CLOs offer 150 basis points historically over risk-free, but it's doing it in a very risk-averse fashion. Now, to your point, if you go down the spectrum, you have about a 2% standard deviation in AAA CLOs. If you go to BBB, it's 4 times the level of risk. And you talk about how should advisors think about this. We only have a AAA CLO ETF, and we only hold AAAs in it. Other ETFs, even though they say AAA, use their 20% allocation to go outside of AAA.
Right.
You do not get compensated well for the risk outside of AAAs from our side.
Well, Matt, one of my questions was going to be, could you venture down the risk spectrum? We know that there's BBB rated CLO ETFs out there. It sounds like you're saying no.
So as an asset manager, we hold $70 billion. We hold some sub AAA, but we do it in a very opportunistic manner. We've thought about it because there's a lot of demand going to the BBB ETF segment. And I've seen a few launch and they immediately gather assets as well. We're going to stay out of that because the yield is really attractive. So think about AAA CLOs at 150 basis points plus over benchmark rates. You get another 150 for BBB. But the drawdown can be north of 10%. The risk return does not make sense for the common investor, so we don't think it belongs as a building block, but we do take advantage of dislocations as an asset manager, trillion-dollar asset manager. We'll use it, but just not as an ETF.
All right, really interesting note to end it on. Matt, great to see you in person. Our big thanks to Matt Collins of PGIM Investments. Now coming up, shifting out of the US, why many clients are now heavily investing in European funds. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with a new leveraged ETF. This one is tracking a pretty small stock called D-Wave. This is a quantum computing stock. I'm particularly interested in this ETF because D-Wave only has a market cap of about $3 billion. So if we see meaningful inflows into this new ETF, it's reasonable to think we could see the tail start to wag the dog. We'll keep an eye on that one. But let's also talk about thematic ETFs. This is an interesting category. So the net inflow for this year is still about $2.6 billion. But since the April 2nd tariff announcement coming from the administration, we've seen nearly $3 billion in outflows. So clearly, appetite cooling a little bit when it comes to thematics, which have had a rocky couple of years. But let's end with the shift in capital flows out of the U.S. and into Europe. We're taking a look at some funds here that are listed in Europe. So these are Europe-listed ETFs focusing on the U.S. And you can see that those products have seen outflows. But you compare that to Europe-listed ETFs that are focused on Europe, those are seeing big inflows. So a real change in traffic there, Scarlett.
Absolutely. So let's talk a little bit more about this trend with Bloomberg's Leonard Kane-Sherpa, who joins us now from London. So Leonard, talk us through this idea, what's happening here. There's been a sell America trade here in U.S. equities. We've certainly seen that across U.S. markets. Is what we're seeing with this flow more a case of people wanting to get out of the U.S., or is it more that people want to get into Europe?
That's a very fair question. So maybe just to take a step back, we looked at these Morningstar data for the first 2 weeks of April for the story we did last week. And they really confirmed and underscored this Sell America theme. And I think the reason why the story got so much attention is because Amundi really came back with some strong comments to us when we put the numbers to them. They really said, okay, there's a massive repositioning going on here. US assets seeming potentially less attractive at the moment. So I think it's more of a case of investors actually looking to go away from U.S. assets, to be honest. And then the second point that I found really interesting is that apparently there's also a bit of a patriotic rebalancing there.
Yeah, the patriotism of it all is really interesting. Usually we talk about that as it applies to the U.S., but talk us through that a little bit more, that point that maybe this is patriotic when it comes to Europeans investing in European asset managers and European funds.
Yes, so it's usually pretty hard to pin down why exactly ETF investors are selling, or especially from where they are selling, from which country. But then Morningstar pointed out to us, if you look at the funds, the iShares Eurostoxx 50 and the Amundi Eurostoxx 50, these funds have gotten the biggest inflows, and they can actually only be sold to investors in France and Germany. On top of that, you had ETFs that focus on Germany's top indexes, which have seen the pretty significant inflows too. So you could take a hint that there's pretty strong trading activity in Germany as a result. And of course, as you know, Germany and France are Europe's largest economies, and they would be particularly exposed to US tariffs. So against that backdrop, Morningstar felt confident to say there's likely some patriotic element in here as well.
Thank you for explaining that. I mean, it's so interesting to hear that kind of commentary from Morningstar. So, Leonard, what about valuations? How do they stack up, Europe versus US right now?
It's, you know, it's an interesting point. I think there's one point that I really wanted to stress as well. Okay, right, there's a move away from US assets. There's a patriotic element as well, but it's certainly not fair to say that there's also a move away from US asset managers. That's the point I really want to make here.
Right.
Because if you take iShares, for instance, they absolutely dominate Europe's ETF scene, but they haven't seen, the biggest outflows from the US equity funds, as you would, imagine from a market leader. And the reason for that is they're cheaper. Right? So Amundi and UBS have seen big inflows into the Europe-focused funds, but they've also seen the biggest inflows, the biggest outflows out of the US-focused ETFs. So I think, at the end of the day, it's fair to say that to European investors, pricing still very much matters.
All right, Leonard, great story. Really appreciate you taking the time to talk about your reporting. That is Bloomberg's Leonard Kane-Sherpa. Now, still ahead, we'll speak to JPMorgan's Travis Spence on why this year is the year of active. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And given that Eric is still out this week, I'm going to take a look at the flows. So let's take a look to start where money was headed to in the week that passed. You have SMBS up at the top, not something you normally see. This, of course, is a mortgage-backed security tracking fund. You can see it taking in nearly $5 billion. And then we get into more of the usual suspects. You have VU, VTI, these track U.S. equities taking in a healthy sum. IBIT also making an appearance on the leaderboard. We know that Bitcoin has been in favor recently. Some are saying it's acting as a safe haven. IBIT taking in $1.5 billion. That's the good news. Let's take a look at the not so good news and take a look at where money was actually leaving from. You have SPY up at the top, losing a chunky $9 billion. I don't know how much to read into that, given that you had VU and VTI taking in pretty hefty sums. You also have this other MBS ETF losing about $5 billion. So maybe a switcheroo happening there with a big investor. Then you have the Qs, LQD also losing some sums. Qs are interesting, given that we know that tech had a pretty good week last week, but as we mentioned, the Magnificent Seven really taking the stage on earnings this week, so maybe some nervousness there. Now, we're just about in May, so let's take a look at the pace of launches so far this year, because it's pretty stunning. You're taking here a look at the average number of new ETFs launched per month. 75 is the average so far in 2025. Now remember, 2023, 2024, pretty much record years for launches as well, but the monthly average so far this year blows them out of the water, Scarlett.
Absolutely. Thank you so much, Katie. So joining our conversation now is Travis Spence, Global Head of ETFs at JPMorgan Asset Management, normally in London, but here in New York for the week. Travis, good to speak with you. I liked what Katie said at the end there, that the number of launches in 2025 has blown out 2024 and 2023. Where are we seeing the most innovation, the most excitement in terms of new launches for ETFs in this kind of volatile environment?
Yeah, well, look, great to be here, Scarlett and Katie. Thanks for having me. So I think 2025 is going to be a really interesting year. You said it before in the intro. We think it's going to be the year of active ETFs. And let me give you three reasons. The first is just flow momentum. So before we get into what we've seen in terms of issuance, flows are about 38% here in the U.S. of all ETFs are going into active ETFs. That's up from 26% last year. So we're seeing a lot of positive momentum just in terms of where investors are preferring to go with their dollars. Second, on the issuance side, so we're now sitting at 50% of all ETFs that are in the US being active ETFs. And of course, you guys have covered that well. Over the last year, more than 80% of all issuance has been into active ETFs. So that is a clear sign, we think, of where the market is going. But think about the market environment that we're in now, and this is clearly a time for active. So we've got lots of uncertainty and tariffs and threat of recession, building. We also have spreads and yields moving around. This is the time that we want to be active. In our experience across our entire JPMorgan Asset Management platform, these are the times, like GFC, like COVID, where we have the best opportunities for alpha. So that all combines, we think, into really the year for active ETFs.
If it's the year of active ETFs, that would obviously be good news for JPMorgan, because I take a look at your biggest ETFs, JEPI, JPST. Those are the two biggest active ETFs, both in equity and in fixed income. So it's a category that you dominate. But what I find interesting is you think about JEPI and JEPQ. It's active, but it's not stock picking active. And you take a look at JPST, that is short duration active as well. So a lot of people look to it as sort of cash-like exposure. So we're talking about active, but not necessarily stock or bond picking.
Well, the majority of what we do is fundamental stock picking and bond picking. And that goes across all of our ETFs. So even JEPI and JEPQ, the underlying long portfolios are based on our fundamental analyst picks. So that is pervasive across everything we do. And that's a really important point and a really important distinction. So the way that we've approached the market overall is really taking the best of our active capabilities, which is mainly on the fundamental side, and we're bringing those into the ETF wrapper. And so we feel that that's a really compelling investment proposition for clients. On top of that, we found ways, and talk about the evolution of the active ETF market. So going back 5 years ago when we had launched JEPI in 2020, and JPST was actually done a couple of years before that, these were where the active ETF industry really started to grow. And investors had access to a brand new, easy access point to get an investment outcome. Now, we've seen that continue to build. And we think going forward that has now become kind of a core part of portfolios. But when you talked a little bit earlier about the direction of issuance, over the last 3 years, there's been this explosion of active ETFs. So most of that is actually going into the core traditional sectors. So think about your large blend, your large cap value, your growth, and then on the fixed income side, intermediate bond, core plus bond. Those are the sectors that going forward, because most of these ETFs still are under 3 years old, so as they gain track record, which is super important in active management, as they gain scale, we think that's where the market is ultimately going to be won. That's the same place where the mutual fund industry was also won or lost. So that's where we see the active industry really going. And we've been really focused on bringing, again, some of the best capabilities that we have into those core sectors.
So all these inflows coming into active ETFs, are they coming at the expense of something? Are people coming out of passive funds? Is this all new money being put to work?
It's been a little bit of both. I mean, again, over the last 5-10 years, investors have become comfortable with the ETF wrapper. Now we've come full circle from passive to factors to fully transparent active. So we're seeing that investor preference shift. Yes, we've seen the outflows from mutual funds over the last 3 years and a corresponding, almost $2.5 billion into, or $2.5 trillion into ETFs. So that's driving a lot of it. It's investor preferences, but now you have access to a much wider range of things, especially in the active side. So think about where flows have gone this year. A lot of the flows in active have been more into the defensive sectors, which has been kind of interesting to juxtapose against some of the beta on plays that we've seen, especially over the last month, into some of the passive portfolios. So investors are looking for risk management.
Right.
They're looking for a different kind of return profile, a different kind of risk return profile. And so the biggest sector within active ETFs so far year to date has been derivative income.
Right.
So it's those strategies that should be protecting on the downside that are doing the job, not only to protect, but also to keep investors invested.
Travis, 30 seconds left before we have to say goodbye to you. I just want to talk about your ambitions. From where you're sitting, of course, head of ETFs over at JPMorgan Asset Management, about $200 billion in assets under management, which is very impressive. But then you think about some of the big guys with $3 trillion. What's the vision? Do you think that you can crack it?
We're going to keep on innovating. We're going to keep on, bringing some of these great capabilities into the market. We see a couple of things happen. Over the next 5 years, we think the overall industry, 15 trillion, goes to 30 trillion. We think active grows from, call it 1.2 trillion today globally to 6 trillion. So within that, we're going to continue to play in that active space. That's growing at double the rate of the overall ETF industry.
Right.
And we see investor preferences continue to go into that. If we can do our job and continue to deliver great results, we think we can probably be managing maybe from 200 up towards to $1 trillion in the next 5 years.
All right, $1 trillion. You heard it here first. Our thanks to Travis Spence of JPMorgan Asset Management. That does it for Bloomberg ETF IQ, the TV show. I'm Katie, along with Scarlett. This is Bloomberg.